If you read the headlines lately, you might think the global financial system is on the brink of collapse. Viral articles are claiming that India and Japan have formed a covert pact to destroy the US dollar. But the geopolitical reality is that Japan's entire defense and economic architecture is built on its relationship with the United States. Tokyo would not benefit from sabotaging American interests. So why are two of Washington's most vital allies in the Indo-Pacific suddenly trying to bypass the dollar in their bilateral trade? Tokyo is initiating a multi-billion-dollar financial maneuver to protect its massive upcoming investments in India. To understand this historic agreement, we have to look past the political ideology and look directly at the cold, hard math of international trade. Right now, the Japanese economy is facing a severe currency crisis. The yen has plummeted to a 40-year low against the US dollar. India is dealing with the exact same problem. The rupee has faced a steady, historical depreciation against the dollar, making imports significantly more expensive. If an Indian business buys Japanese machinery, they convert rupees into US dollars. Then Japan converts dollars into yen. This middleman forces both nations to incur exchange rate losses. The solution is a direct rupee-yen settlement system. Cutting the dollar saves millions in conversion fees. This localized trade agreement is a mathematical necessity. Neither country wants to bleed cash just to conduct everyday business. This agreement directly supports Japan's commitment to invest roughly 60,000 crore rupees, or 10 trillion yen, in India by the year 2030. This includes high-stakes military hardware. Japan is currently offering to co-produce Mogami-class stealth frigates in India under the Make in India initiative. To execute this, Japan must deploy serious capital. This chart compares funding the investment through US dollars versus directly using Japanese yen. Buying US dollars at a 40-year high unnecessarily inflates costs. Investing directly in yen keeps their costs flat and insulated from the dollar. When these infrastructure and defense projects mature over the next decade, the yen will likely have recovered. Japan will gain a significant advantage by buying into the Indian market while their own currency was at its lowest point. As a byproduct, they establish a localized Indo-Pacific defense network where warships can be built and serviced across India, Japan, and Australia using a standardized regional supply chain. By pushing for a local currency settlement, Tokyo maximizes its returns while minimizing currency risk on its long-term projects, regardless of any global anti-dollar sentiment. At the government level, this sounds flawless. India has already pushed forward with similar currency agreements with the UAE, Indonesia, and the Maldives. These deals are formalized at the highest institutional levels and fully backed by central banks to project confidence to the public. But the truth on the ground tells a very different story. Despite all the historic memorandums, private corporations almost always default to settling their trades in US dollars. Private traders hesitate because the rupee historically lacks stability. On average, it depreciates about 4% against the dollar every year, and sudden market shocks can push that drop even higher. This line graph illustrates the private trader's dilemma. A $10 million reserve retains its value over time. Holding that exact same value in rupees is risky because the purchasing power steadily vanishes, while the dollar remains a reliable safe haven. A national currency only sees genuine global demand when its home country mass produces world-class products that the international market absolutely needs to buy. The India-Japan deal secures vital bilateral defense and infrastructure goals. But in the broader private market, stability always wins, and the US dollar remains the primary currency of global trade.
If you value clarity over chaos, explore more on Clear Lens X.